we're seeing a different story for markets today from some of the doldrums that we saw yesterday. This fear about contagion from the banking, what was thought to be some systemic risk in banks. But here you see reports from the Wall Street Journal that JPMorgan, Morgan Stanley and others could be in talks to bolster First Republic, that giving a bit of confidence. Do you think the market action now is better reflecting the reality than some of the fear of the systemic risks that we were seeing yesterday?
So the banking sector is very critical to the broader economy, and that is part, of why the focus has been so heavy. Clearly, the Fed, the FDIC, the Swiss National Bank are doing what they can to ensure, more confidence from those who are either have their deposits there, are borrowers for these banks, or shareholders. While, we think that it's going to take some time for this to work its way through the system, but certainly, there's some efforts, and that's kind of why we're seeing amidst a lot of volatility and likely more volatility to come, but today, a turn in stocks.
So how long do you think we're going to keep seeing sort of the volatility or repercussions from what we've seen from SVB's fallout and Credit Suisse as well?
Yeah, it can take months to work through the system because clearly, when banks are in this type of situation, there's a potential for contraction in terms of, lending, and that can lead to tightening financial conditions. So it can take some time, and certainly I think this volatility will be with us for short term at a minimum.
And we're getting some recession projections, as Jared was just mentioning there. How do you think this latest fallout, how do you think that affects the path that we get to recession and perhaps the severity of the recession as well?
Absolutely. So, from even as we look at it from a monetary policy perspective, it's difficult, right? Because they're trying to target inflation, but they have to consider the tightening financial conditions. And that's where it becomes more difficult to predict. But, from our perspective, a recession does seem more likely than not. And these types, the financial conditions tightening really kind of helps bring it forward. But still, we equally do not think that, a recession is likely this quarter, but certainly it's on our radar as concerns are increasing.
And we did see that the ECB, the European Central Bank, still staying the course, raising their interest rate 50 basis points there. What do you think of that move? Obviously, some of these central banks have been trying to move in concert, but this is sort of uncharted territory at the moment.
Yeah, it almost seems like they had this plan and they went with it, given that but they did highlight that they are continuing to monitor financial conditions and that they will be data dependent. And so, that kind of, while they went with the 50 bip rate hike, which may seem a bit hawkish, certainly, however, I think they've built in the optionality in coming months to be data dependent and as well as watch, if there's further market deterioration.
And a lot of people wondering where they should put their money. We've seen this rush, especially into short-term bonds. Where are you putting your money to work as this continues to play out over the next couple of months?
Yeah, while the concerns are mounting, we think fixed income does look attractive here. You have a decent level of yield and income and some downside protection relative to, say, equities. So amidst all this volatility, we still think fixed income looks attractive.